Okay, so now we get into some fun stuff, and it's the quantitative analysis of this raging debate around active and passive. And so there's just lots and lots of data. So inside the class, we've always really given you the ability to make your own decision and bring about these arguments on should you be a passive investor or should you try to find the active manager. So I'm going to go through that, and then in a little bit we're going to bring on Phil, and we're going to explore for the rest of the night about just ESG and environmental and social. So can we put that slide up? So what does Warren Buffett say? It's interesting that he says that his portfolio when he dies wants to be 90% S&P index fund, 10% cash. That's what he's basically talking about, not for Berkshire Hathaway, but for his kids. So people where he gives money. But then again, what's the next question is, wait a minute, isn't Warren the greatest investor of all time, and hasn't he outperformed the index? Absolutely. So do we have an ability to identify an asset category that is better than the benchmark? Now, if you can give me my iPad really quick, then I can blow this up. So can we go full screen? So here on the right, what we basically have is we have an amount of money and a 10-year performance over time. So if you look at the numbers up on the upper right, you see the fund. And again, this isn't for everybody to run out and buy this particular fund because Walter demonstrated in his summit. This is just, I'm using it as an educational tool. This actually is a recommendation by Bob Brinker in his No Load Mutual Fund newsletter. So that's where I pulled it. But so you notice over this 10-year period of time, the index went to 42,000, the fund went to 51,000, but then the category went to 34,000. So there's a couple different things happening here. One is this particular fund has done very well over a period of time, but the rest of the group has not done as well as the index. So one of the things that you come into when we go into active and passive is when you try to go out and find managers that can do better than the index, you bring in the opportunity for you to do worse. So on a going forward basis, we're going to have a discussion around manager selection. So you want to have a clear view of what the manager is supposed to do. Is he defensive? Is he offensive? Is he supposed to weather difficult markets, challenging? What is the method? So we really have two types. We have investment managers, and then we have investment advisors. A lot of times people get confused because an investment advisor really isn't an individual manager. They're more of a quarterback for your allocation in running this particular process. Like Bobby and Scott are investment advisors. They don't physically manage particular categories. So I want to make sure we're talking about investment managers, people that invest and pick stocks in a particular category. So if allocation is the key, why should we try? I mean, that's the question. Well, it's part of the class. We got to kind of show you at least how to do it. So there's two methods in selection. One is the quantitative, kind of the mathematical numbers, and two is the qualitative side. So quantitative, qualitative side. Two very, very important pieces. So step one is we look at just the qualitative side. What is the quantitative side? So the track record, the stability. Step two is what's their method? How do they do what they do? Number three is what's their people, their process, their philosophy? How do they get there? So then you get into this, okay, now the active debate really rages. So what are we looking for? We're looking for, can they average returns over and above the market on a consistent basis after fees? That's it. That is what we're looking for. But then when you look at all the universe of managers, so think about, I don't know how many there are, 10,000, 20,000, 30,000. There's just a lot of people. So when you have law of large numbers, you're always going to have a section of that group that are going to outperform. And so the thing that we really look at is we say, is it luck or is it skill? Which one is it? And so we look at these quantitative measures called beta, alpha, R squared, and Sharpe ratio. And I will tell you that after taking this class, you're going to know, and this is sad, is you're going to know more about manager selection than, I'm going to say, 90% of the investment advisors who can't really talk about what these statistics really mean. So let's kind of move into them. So first of all, we look at beta. And so what is beta? Beta is like this river. It's the amount of return that comes to you based on just being in the river. So if the river is going slow or fast and you're canoeing down the river, that's the contribution of the market. So when you're in an index fund, you're just going to be in a canoe and you're going to do nothing. You're just going to float down the river. So as a manager, should you get credit for the speed of the river? No. You want to get credit for your skill. There's different rivers. So there's different rivers that go different speeds. We've definitely seen that in this market where large company growth stocks are doing much better than mid-cap stocks and small-cap stocks, and U.S. is doing better than international over the short run. So we look at this, and the reason beta is important because it's going to show us, okay, if the market did 10% and we have a portfolio that has a beta of 1, then we can expect to get a 10% return. So now all of a sudden, based on what the market does or what the manager does, we can tell if he added skill or not, because we understand what his market beta is. Let's say a manager takes less risk than the market, then they should get less return. Or what if the manager takes more risk? And so we'll see that in the beta number. And that's where it's very helpful to us. So beta is this measure. This other statistic, and I know everybody's like super excited right now because you got your quant glasses on right now, is this thing called R squared. And what is R squared? Well, R squared is saying, okay, if we're a manager and we're comparing ourselves against a benchmark and we're demonstrating that we can add skill over and above, or return over and above the market, we need a measurement that basically says, are we in the same river? Because remember, you have small cap, you have mid cap, you got large cap, you got value growth. So does it ever happen that you have a manager that's categorized as a growth manager, but then they cheat and become a value manager and vice versa? Yes. How would you know that? Well, you have to look at their R squared, because at 100% as R squared, that means that the manager has a high correlation, perfect correlation with the index. So when you look at an index fund and you look at its R squared, it'll be 100. So when managers get R squareds below 80, that means that, hey, the market's doing this and the manager's doing this over here. They may be cheating. They may be investing in other areas. So R squared is a really, really good, what we call honesty tool. Are you in the right market? Are you in the right river? Okay, because you've got the Russian River, you got the Mississippi River, you've got different things, because if you don't think that fund managers don't play shenanigans, because they're compensated a lot of times based on performance. And so happens all the time where you have this thing called style drift and they'll cheat. So is it fair to compare this guy in this river with this guy? It's not. This might be the large growth river right now, and this might be the small cap river. Just not doing as well. But you're more concerned with diversification and having your money in all kinds of different buckets. So you are going to have areas of the market that aren't going to do as well. as other areas. And so it's not let's try to find the best area, it's just let's have diversification amongst the different categories. So if you're in a river that isn't doing as well, you can't measure yourself against the good river. You got to measure yourself against your peers. So that's R squared. So here we look at an example of a particular fund, and we're showing you their statistics, and their R squareds are 88 and 89. So it has a level of reliability that it is accurate. So alpha, it is the thing that we really look at. What is alpha? Alpha is that incremental return that we yearn for. Warren Buffett had a very, very significant alpha in his ability to manage assets. And so in this particular category, we see this particular fund, and again, we just use this as an example. This isn't, let's go out and buy this particular fund. We just say, okay, it had a 1.9%, almost 2% alpha over and above the benchmark during its 10-year period. So the active guys, this is their commercial. And what we're basically saying is that the investment guys that talk about active better know their statistical measures of beta, alpha, R squared to be able to guide you through what their selection process is. Because ultimately, what we're looking for is we're looking for this. We're looking for manager skill. We're looking for the guy that has that ability, like Warren Buffett knows, the right industry, the right companies, and therefore measure skill. Now, this is an example of an index fund. This is just somebody that is floating down the river. Now, you got to be careful because you're going to pay more money for the active guys, the fees and the costs associated with them, because they just have more to do. So can they incrementally deliver that additional return? And when do they paddle? So here's another guy, and he's in his canoe and he's paddling. And then here's another couple, they're about ready to come into a little bit of an area. But so you begin to see the relationship between the river, which is beta, and the paddlers, which are the manager, and being able to separate the two to get to your alpha. Challenge that you have when you go look for alpha, you may bring in negative alpha, which happens quite a bit, and then you've got somebody that is trying to navigate. So then the question is, which one is fastest? We really don't know which one out of those three people in the canoes are a better, I don't know if the right word is canoer, but which one is more skilled on the river? We don't know because they're in different rivers. So that's the thing that you really that you separate out by looking at these numbers. So this is the area of alpha. The sources where it comes from is skill. Sometimes they'll exploit an inefficient asset class. Sometimes they'll look for non-correlation, tax efficiencies, fear. Remember what Buffett says, when people are fearful, I'm greedy. When they're greedy, I'm fearful. So it's really just, it's about selection. It's about understanding industries. And so they create it in a number of different ways. And so if we can take this to full screen, and I'm going to put on my magnifying glass for a second, but you can see that in this particular, the ACRI Focus Fund is a fund that has had a long history of outperformance. Instead of its alpha being 2%, its alpha is a little over 3. It has a beta of 1, and it has an R square of 90. So you can look at the statistical measures of this particular fund. Now, we haven't dived into the qualitative side of the people, the process, the philosophy, how they got to that additional return, what decisions that they made in order to consistently create that 3% alpha. We're not really there yet. That's all part of the selection process. We're just going to go through the quantitative measures for tonight, but that's all part of what you do, because what we're looking at is it's really easy to look in the rearview mirror and go, oh great, that's a great fund that I should have owned the last 10 years, but I don't know if it was the fund that I need to own over the next 10 years. So that's part of the secret sauce of this thing called selection, is is it repeatable in terms of what they did the last 10 years and whether or not they are going to have the ability to continue all that. The next thing we look at is Sharpe Ratio. Okay? And that's it. I swear to God. I'm not going through any more statistical measure. That's it. And then I'm going to bring Phil on. But Sharpe Ratio is a great measure because remember what Bobby said. He called it the value of happiness in your ability to weather these storms on your psyche. You may weather the storm, but you may have a lot of stress and you may be fighting with your spouse, or it may just give you internal anxiety. So what the Sharpe Ratio does is it measures the amount of return you get for each unit of risk that you take. Okay, so it's a great ratio, and the way that Sharpe Ratio comes into play is when you're comparing a lot of different managers. You might have the one manager that has less return but takes significantly less risk. So a lot of times what people do when they talk to their investment guy, they say, hey, what's your performance? How have you done over the last 5 years? Bad question. You got to know, okay, I made this amount of return and I took this amount of risk. So we look at like these guys. So this guy's a high wire tightrope walker, but he's tethered. Okay, so he wants to get from one side to the other. Then you got this guy, he's got this big pole. All right, so he's probably going to get there. And then you got this gal, absolutely not. So who would you rather be? You're going to get to the same destination. You're going to get across the pole or across the tightrope, but how are you going to get there and what safety mechanisms are put in place? So Sharpe Ratio really kind of helps us to do that. And when you can compare a lot of funds, you can do that. What I might do next week is I'm probably going to bring up some Morningstar data. And one of the things that you can do in Sharpe Ratio in a database, and your investment guy can do this for you, is you can actually screen for particular funds and then you can sort them based on their Sharpe Ratio. It's a fascinating risk-adjusted measure because it separates out, again, return based on how much variability, because when you're in that distribution phase, variability is your really is your enemy. So if you had two portfolios, one that did 25% and 120, you'd say, okay, the 25%, give me that one. That's the one I want. But if the Sharpe Ratio of the second portfolio, the first portfolio was 2 versus 125, you just get a lot more. You got a lot more bang for your buck. So where's the application? So active, passive. Where do we do it at, and where does it fit? Well, you talk about these satellite managers, and so it's the data says that when you're dealing with large company stocks, the majority of those managers underperform the index. But when it comes to some of the more inefficient markets and illiquid markets, in small cap and emerging markets and international small, that those areas managers actually can create much more additional alpha on a consistent basis, and the ratios of outperformance are much higher. So then when do you fire a manager? And so here's the issue, and I go back to the kind of simplicity in the Southwest Airlines commercial. So when you get into active, is you have more decisions that you're wrestling with, versus if we create an allocation and we just hire index funds, the only additional thing that you have is a rebalancing method. But if you hire active, you have to go through the active process, and then you have to monitor those active managers to make sure that they're adding that alpha over and above that relative benchmark. Challenge with that is about 30% of the time the really good active managers that add alpha underperform. So you're going to have negative alpha for a period of time on the way to getting the positive alpha. So what do people do with that? They sell. So then here's the question about, well, when would you When would you fire a manager? Well, consistent underperformance versus the benchmark of the peer. But again, a lot of times people compare the particular manager against the wrong thing. They're in the wrong river. So if they had a value manager in the late 90s and a growth manager, growth was doing well, value was doing poorly. Kind of like today, your value managers are not doing what your growth managers are doing. Kind of vice versa. So you got to make sure that you're comparing the right river. Style drift is significant, where a manager decides to manage your assets in a different way. It happens all the time. And then dramatic changes in management, changes in buy discipline. You know, there's a lower alternative that you find. And so really, what are we left with? And I think that we really want to go here with this particular slide. And it's really dangerous, because think about this. You go find a manager that you're looking for good returns. So you're going to screen the databases and you're going to hire that guy. And then that guy, for whatever reason, doesn't work out. And then what are you going to do? You're going to go to your guy and say, hey, that fund that you bought me, that acre fund that Walter talked about, it's a dog. And so you're going to sell it when it's down. And then what are you going to do? What are you going to go look for next? You're going to go try to find that fund that's doing really well. So then guess what happens? The fund that you just sold that's now doing poorly starts to do good. And the fund, so there's all kinds of those kinds of decisions, because people, when it comes to the active side, they make decisions for all the wrong reasons. They don't understand the river. They don't understand beta. They don't understand the managers where they are. They don't understand how markets rotate. And so they confuse the category of that markets in a particular area aren't doing well. So they're like, give me more growth, because my growth guys are doing really well. My small cap guys aren't doing well. So let's sell the small guys and let's buy the growth. And that's where you get this sort of scenario. And you see that with people moving in and out of different and particular funds. So